Welcome back to the Trade Savvy Academy. I'm absolutely thrilled to welcome you to today's video, where I'm diving deep into my personal journey with two powerhouse ETFs, the Schwab US Dividend Equity ETF, SCHD, and the Vanguard Dividend Appreciation ETF, VIG. Buckle up, because I'm about to break down exactly how much cash these investments have pumped into my pocket so far in 2025 with my 2,000 shares of SCHD and roughly 300 shares of VIG. But that's just the start. We're also going on a time travel adventure to see what this portfolio could be worth in 10, 20, and even 30 years if I keep holding and reinvesting those juicy dividends. Stick around until the end, because I'll share why these ETFs are a dream team for building wealth, how they differ, and key tips to supercharge your own dividend strategy. Whether you're a seasoned investor or just starting out, this video is packed with insights to inspire your financial future. So let's jump right in and stick with me until the end of this video, because I'm about to tie it all together with some actionable takeaways. First up, let's talk cold, hard cash. How much have SCHD and VIG paid me so far this year? As of June 26, 2025, my 2,000 shares of SCHD have been working overtime, delivering some serious dividend love. For the first quarter of 2025, SCHD paid 24 cents per share, which means I pocketed $497.60. Then, for the second quarter, with an ex-dividend date of June 25, 2025, that just passed, I'm set to receive 26 cents per share, adding another $520.40 to my wallet. That's a total of $1,018 from SCHD alone. Now, for my 300 shares of VIG, I collected $281.31 in the first quarter at $0.9377 per share. The second quarter's ex-dividend date for VIG is June 30th, 2025, so that payment hasn't hit yet. Adding it all up, these ETFs have paid me roughly $1,299.31 in dividends so far this year. That's money I didn't have to lift a finger for, just for owning these shares. It's like getting a paycheck for doing nothing but holding smart investments. How's that for passive income? Now, let's get a quick snapshot of where my portfolio stands today, because this sets the stage for our future projections. As of today, SCHD is trading at $26.36 per share, so my 2,000 shares are worth $52,720. VIG, on the other hand, is sitting pretty at $203.10 per share, valuing my 300 shares at $60,930. That gives my total portfolio a current market value of $113,650. Not too shabby, right? This is the foundation we're building on, and it's exciting to think about how this pot of money could grow over time, especially with the magic of dividend reinvestment. But before we fast forward, let's talk about why SCHD and VIG are such rock stars in the ETF world, and why they're a perfect combo for investors like us. Let's break down what makes SCHD and VIG so special. SCHD is all about high dividend yields, with a current yield around 4%. It's packed with stable, cash-flowing companies like Verizon, Coca-Cola, and Pfizer, focusing on sectors like consumer staples and utilities that hold up well even when the market gets shaky. VIG, meanwhile, is the growth champ, with a yield of about 1.8%, but a focus on companies like Microsoft, Johnson & Johnson, and Procter & Gamble that consistently increase their dividends over time. VIG leans more into growth sectors like tech and healthcare, giving it a nice balance with SCHD's defensive vibe. Both ETFs have crazy low expense ratios, 0.06% for SCHD and 0.05% for VIG, which means more of your money stays invested and working for you. Together, they're like peanut butter and jelly. SCHD gives you immediate income, while VIG sets you up for growing payouts down the road. This diversification is key, and it's why I love holding both in my portfolio. Now, let's get to the part you've been waiting for. What could this portfolio be worth in 10, 20, and 30 years if I keep holding and reinvesting those dividends? To figure this out, we need to look at historical performance. SCHD has delivered an average annual return of about 12% since its inception, factoring in price growth and reinvested dividends. VIG's been no slouch either, with a 10-year average return of around 11.3%. Since my portfolio is roughly 46% SCHD and 54% VIG based on current values, I'm using a blended annual return of 11.5% for our projections. This assumes the future mirrors the past, which isn't guaranteed, but it gives us a solid starting point. So, let's crunch the numbers and see where this ride takes us. Starting with our current portfolio value of $113,650, let's project 10 years out with that 11.5% annual return, assuming dividends are reinvested to compound the growth. Using the compound growth formula, in 10 years, the portfolio could grow to about $337,000. That's nearly triple what it's worth today, all from letting those dividends work their magic. Now, let's stretch it to 20 years. At the same growth rate, the portfolio could hit a jaw-dropping $1 million. Yes, you heard that right, $1 million. And if we go out to 30 years, hold on to your hats, because the numbers get wild. Approximately $2,970,000. That's almost $3 million from a starting point of just over $100,000. These numbers show the incredible power of compounding, especially when you reinvest dividends to buy more shares, which then generate even more dividends. It's like a snowball rolling downhill, getting bigger and bigger over time. Before I move on, don't forget to follow me on X for my live trade alerts at the handle shown on the screen.
But let's pause for a second and talk about why these projections are so exciting yet come with a reality check. The 11.5% growth rate is based on historical data, and the market can be a roller coaster. Economic shifts, interest rate changes, or unexpected events could impact returns. That said, SCHD and VIG are built to weather storms. Their focus on quality, dividend-paying companies means they're less volatile than the broader market. During past downturns, like the 2020 crash, both ETFs held up better than many growth-heavy funds because of their stable, cash-flowing holdings. Plus, reinvesting dividends during market dips lets you buy more shares at lower prices, supercharging your returns when the market recovers. It's a strategy that rewards patience and discipline, which is why I'm so passionate about sharing this with you. Let's zoom out and talk strategy for a moment. Why should you care about SCHD and VIG? For one, they're perfect for investors who want both income and growth. SCHD's higher yield is great if you need cash flow now, maybe to cover bills or fund a side hustle. VIG, with its focus on dividend growth, is ideal for those of us dreaming of bigger payouts in the future, especially in retirement. Together, they give you flexibility. You can live off SCHD's dividends today while VG builds your wealth for tomorrow. And here's a pro tip: reinvesting dividends, like I'm doing, is the secret sauce to those massive future values we talked about. Every dollar you reinvest buys more shares, which means more dividends, and the cycle keeps growing. It's like planting a tree today that shades you for decades. Another cool thing about these ETFs is their tax efficiency. In the US, most of the dividends from SCHD and VIG are considered qualified, which means they're taxed at lower capital gains rates rather than ordinary income rates. This can save you a chunk of change, though taxes depend on your personal situation, so always check with a tax pro. Also, their low expense ratios mean you're not bleeding money on fees, unlike some actively managed funds that charge 1% or more. Every penny saved on fees is another penny compounding in your portfolio. Now, let's address the elephant in the room. What if the market tanks? No investment is bulletproof, but SCHD and VIG are built for resilience. Their focus on financially strong dividend-paying companies means they're less likely to slash payouts during tough times. In fact, VIG's holdings have a track record of increasing dividends even during recessions, which is a huge vote of confidence. SCHD's defensive sectors, like utilities and staples, tend to hold steady when growth stocks wobble. By holding both, you're spreading your risk across different sectors and strategies, which is a smart move for long-term investors.
First, let's recap. My SCHD and VIG portfolio has paid me $1,299 in dividends so far in 2025, with a current value of $113,650. If I keep holding and reinvesting, it could grow to $337,000 in 10 years, $1 million in 20 years, and $2,970,000 in 30 years,
based on historical returns. These numbers are a testament to the power of dividend investing and compounding. But here's the real kicker. You don't need 2,000 shares of SCHD or 300 shares of VIG to start. Even a single share gets you in the game, and over time, those dividends can snowball into something life-changing. Before we wrap up, let's talk about how to make this work for you. First, start small if you need to. Just one share of SCHD is about $26, and VIG is around $203. Set up automatic dividend reinvestment through your brokerage to let compounding do its thing. Make sure your dividend income exceeds the price of one share of the ETF so it can be automatically reinvested to purchase additional shares. Second, be patient. The projections we talked about took decades, so don't expect to get rich overnight. Third, diversify like I did with SCHD and VIG to balance income and growth. And finally, stay consistent. Keep adding to your portfolio when you can, even if it's just a few $100s a month. Over time, those small contributions add up, especially with reinvested dividends. All right, folks, that's my SCHD and VIG journey in a nutshell. I hope you're as pumped as I am about the potential of dividend investing. If you found this video helpful, smash that like button, subscribe, and hit the bell so you don't miss my next deep dive. Drop a comment below. Tell me, are you investing in SCHD, VIG, or another dividend ETF? What's your long-term wealth goal? I read every comment and love hearing from you. Thanks for watching. Keep building that passive income, and I'll see you in the next video.